You are listening to the ESG and Coffee Podcast on investment, strategy, and sustainability, hosted by Graham Sinclair.
Well, what are we trying to actually accomplish here? Is it to have a correlated strategy that's a little bit more green than business as usual? Or is it to point capital at what an indefinitely sustainable economy can and will look like? And we very much decided on the latter. And the more we developed our thesis and the more we thought it through, the more we realized that not only is that the way to have maximum impact with your strategy, but it's also the most clear path to long-term competitive returns. On a go, no go for possible inclusion into our strategies, is this company doing more to fix our problems? Is it doing more to stabilize the world or to destabilize the world? And I think that's best reflected by source of revenues. And I think that if you're earning the majority of your revenues doing something to stabilize the world around climate, around resource degradation, around worsening inequality, it could be around human disease burden. So this is where climate and disease burden are where the bikes come into play.
There you go.
So if I thought it was scalable, if I thought it had defensible IP, if they were doing it better than any other bike shop on the block, in an intellectual property defensible way, and it therefore was going to scale and provide great returns for my clients, I'd have that conversation for sure.
I think we just launched Gig Bike, Growth and Income Gravel Bikes, Gig Bike.
I'll be a investor and a customer. The trails around here are wonderful.
Yeah, they are. I do remember that.
And why are they in our strategy to start with?
Yeah.
They want their returns to outpace inflation over time and therefore at least maintain and ideally grow their buying power into the future. That's why we invest.
Yeah.
So the reason to do that is to own the things that are going to grow rapidly into the future, more rapidly than the underlying economy, and therefore improve your buying power opportunities into the future. And genomics are going to be a very key way to do that. And I just let them know they're leaving that card on the discard pile, and it's not going to advantage them.
I'm pleased to introduce you to episode 3 of ESG and Coffee Podcast. And our investor guest is Garvin Jabusch, the Chief Investment Officer and co-founder of Green Alpha Advisors, based just outside of Boulder, Colorado, in the USA. It's Olympics week to Tokyo 2020 right now, and Boulder is actually the high performance center in the USA. A lot of endurance athletes are there, so it's timely. I first met Garvin in the early 2000s. In fact, I'm holding in my hand now a khaki-colored canvas cap with the Sierra Club founded 1892 logo inscribed on it and mutual funds underneath. I think this was the cap that Garvin gave me when he was promoting the fund in the early 2000s. I think that's when we first met. It's also a reminder of how generously he was treated by his previous employers at Forward Funds when he actually went to co-found Green Alpha Advisors. They allowed them to take their strategy with them, and so Sierra Club moved their mandate with Garvin and his co-founder, and they've continued to manage that over more than a decade now. It's also a reminder that I featured Garvin's fund and strategy in an academic paper with Professor John Doe at Villanova University and Terence Gué when he wrote a paper on NGOs, shareholder activism, and investing. It was published in 2004. I'll drop that in the show notes. You'll hear from Garvin what an interesting, open-minded, curious person he is. He's very pithy with some of his responses. For example, he distilled his investment philosophy into, quote, "Problems aren't worth much, solutions have value," unquote. You'll hear how his journey started with a job offer on the West Coast and how an experiment in looking at environmental, social, and governance factors worked out and has brought him to where he is today. To be very successful. A headline, if you will, is the fact that he is a triple-digit fund manager. He and his colleague had a fantastic year in calendar 2020, returning 113.9% in 1 year for their clients. But you'll also hear in the podcast how there can also be a downside. There's a dark side to being a popular fund manager, at least in the business of investment. You'll also be keen to know that currently Garvin and his colleague are looking to add to their team. They're looking for an experienced equity analyst. And from the job spec, which I'll include in the show notes, there's a quote, we need an equity analyst with enough industry experience to understand that some aspects of traditional asset management work well and that some aspects are meaningfully outdated and broken, unquote. You'll hear much more about Garvin's philosophy and the processes they employ to find the right companies to invest into in our conversation. As always, at the end, we have the bonus tape where we kind of kick back and reflect on the interview and update some of the things we said, maybe expand on them or check on something that we wanted to say but didn't say. And at the end, I always do the summary high points, about 5 minutes, kind of wrapping the episode and what we've learned. A caveat, as always, ESG and Coffee Podcast is not investment selling. We are here to learn. We're looking at this through the eyes of an ESG architect. So please sit back, do your gardening, be on your hike or your long cycle, and enjoy this long-form interview with Garvin Jabusch, Chief Investment Officer at Green Alpha Advisors. Welcome, Garvin Jabusch. How are you today?
I'm well, Graham. Thanks for inviting me. Pleasure to be here.
It's great to see you looking well. Mindful of where you're based, I've actually been to Niwot, as it turns out, on account of my wife's family. So how are things today in Niwot?
Yeah, they're good. We're just right here in Boulder County, Colorado, just a couple of miles out. We're sort of an exurb of Boulder. And it's nice here. You know, it's a beautiful spring day, 68 degrees. Couldn't ask for more.
Excellent. Good to hear. First call, if we were at your local cafe or coffee shop and I was heading up to the counter to buy you something to drink, or what would be your drink, sir?
You know, I traditionally just go with a black medium roast. I just like it straight, I guess.
Okay, nice one. And do you have a local barista or shop you want to give a shout out to?
Yeah, our folks over at the Old Oak Coffee House right here in Niwot are our favorites. The manager there, Hannah, is always really good to us.
All right, there you go. Cheers to that. Cheers to Hannah and the staff.
Cheers.
So let's start off by looking back. I don't know if you've watched Sir David Attenborough's superb Netflix documentary, Our Planet. Have you had a chance to look at that?
I did watch that. It was fantastic.
Yeah, really, really good. A mate of mine's actually an underwater photographer, a videographer. He's done some work with Sir David.
Wow.
And in that show, Sir David referenced two significant data points, which illustrate the exponential changes that have happened over his lifetime, which I felt to be really important. So I went ahead and asked you as my guest to look at not just those two data points, but another data point. So here we go with the question. In the year, you earned your first career paycheck. Now, you don't have to tell us what year or how much you made. You can if you want to. But roughly, how much was each data point? Question one, world population.
Well, I will disclose it was 1995. And I don't remember what I made, but it wasn't that much. And in those days, the world population was about 5.7 billion.
Wow. Okay. And the S&P 500?
It averaged that year, I looked it up, it averaged that year about 542.
Wow. Okay.
I know.
And then carbon dioxide in parts per million in the air.
You know, it was only about 80 above pre-industrial. It rang in about 360 that year.
Wow. The good days, hey? So for reference for the audience, population today in March 2021, around 7.9 billion. S&P 500 tracking around 3,890. And CO2 equivalent around 417 parts per million measured in Hawaii. Garvin, how does it feel to look at those numbers and look at the numbers today? How does that feel?
It's daunting, really. The delta between then and now, it reveals a lot. You know, that means that in terms of parts per million of CO2 in the atmosphere, by 95, everyone knew climate change was real. Everyone who paid attention to science at all. and that includes policymakers and everybody in a position to do anything about it. And that means that more than half of our emissions have been done in full knowledge of what we were doing, not in innocence of just this, oh, wow, these fossil fuel things were great. That isn't true of most of our like cumulative emissions. So that's daunting. And then just the growth of the economy, just not just the markets, but the economic expansion that's revealed by that SPX number is bigger than I I guess imagined.
Yeah.
You know, so why another way that it's daunting is the economy is going to keep growing. One assumes. So what's global GDP today? Right, about 87 trillion. So soon it'll be 90, and then on to 100 and 125 trillion, and that flat can't happen on the basis of legacy economic practices.
Yeah.
So it makes me feel worried about the future, but also like it gives me a lot of clarity around my investment decisions.
Yeah. Oh, really helpful. And one thing adding to that is, and I even felt this with Sir David, he faced the criticism about not talking enough about climate and he does fantastic work. We can all agree, he's been a huge asset to all of us. And then he started to do that. And even to watch him be interviewed, and I read up and watched some of his other interviews, it's really, really clarifying, right? There's no fuzz, there's no noise of news cycle or what have you. It's just, there's a number at that point, and there's a number at that point. So significant. Let's kick on then to some fast espresso shot questions. Set number 1. Are you ready?
I'm ready.
Okay, there are no wrong answers. Here we go. What is your earliest memory of investing?
When I was a little kid, my grandparents bought me some treasury bills,
Really?
some 10 and 20-year notes, just to kind of, first of all, as a gift, and secondly, just to show me a little bit about investing. And that's the first thing I remember. I remember it kind of blew my mind when they explained it to me. I said, wait, I'm lending the government money? That didn't seem to make sense to me at the time. It was pretty cool intro.
Okay. Was it actual paper? Did they like?
Yeah.
Okay.
Yeah, it was an actual paper cert. It kind of looks like how a treasury check looks now.
Okay.
Same seal on it and everything.
Yeah.
And it had like some punch card holes in it that I guess were machine readable at the time. This would have been about 77.
Yeah. Oh, that's amazing. Amazing.
Isn't that funny?
Yeah. Question 2. What is your philosophy of investing in one sentence?
I think it's that problems aren't worth much and fixes have value.
Excellent. Interesting. What switched you on to environment, social governance, ESG?
I started my career at Morgan Stanley, and I was there for a few years before I got the opportunity to move to San Francisco and manage a thing called the Sierra Club Stock Fund. And it was really that job offer that did it. Back then, Morgan Stanley didn't know how to spell ESG, or much less sustainable, and it wasn't really being done. That was in 2001, and I got to San Francisco, and Forward Funds, who managed the Sierra Club Stock Fund, gave me the opportunity to run this thing, and it had never crossed my mind you could have a broad-based, diverse portfolio without fossil fuels in it until then. But I found not only did it work, but I managed to keep that thing in the top decile among large core funds the whole time that I managed it in association with my co-founder here at Green Alpha, Jeremy Deans. And we realized it not only does it work, but it works incredibly well. And we haven't bought a fossil fuel company since 2002 as a result, professionally speaking, or private either. So that's really how I got started. It was a job offer. And then I thought, this is amazing and it works.
Huh. Oh, wonderful. That's a great story. This is why I'm doing the podcast. Like, these are the stories that I want to be hearing and sharing. And we will come back to that fossil fuel comment in the third deep dive.
Sure.
How do you choose to define sustainable investment or investing with ESG factors in less than 30 words?
Well, I think it's keeping a narrow focus on the end game of what a global economy that can thrive indefinitely without overtopping Earth's capacities will look like. I think it's keeping your eye right on that end game and not getting lost in the minutia of process or the details, overly quagmire details of ESG scores. Just, is this company, I've gone way over 30 words.
Man, I've got to buzz you out. I got to get a buzzer for that, right?
Yeah, buzz me out.
Yeah.
Is this company contributing to that end game or not? is where I'm really going.
All right, nice. And then what is your biggest investing mistake so far?
I think it's trying to time, waiting too long and missing some gains. We've learned that over and over, unfortunately, that when you determine something's a good idea, you've got this complicated process. You've got this really in-depth stock selection process. And once you've improved something for investment via that process, just go ahead and buy it. Don't wait. Don't try to time. Don't wait for a pullback. Just go for it.
Okay. Most of my regret is linked to buying the electric car, not the stock, but we'll talk about that later too. The car is excellent, by the way. Yeah,
that's still a good buy, though.
I know.
Nice.
Still good. All right, here we go. Deep dive part one. So first of all, I'd like to just frame the investor value chain. It has many links in it, many humans playing different roles. There's the asset gathering, the asset management, there's the research piece and the influence piece and so on. Describing yourself, Garvin, and your shop, where do you sit in the investment value chain? Simply put, very simply.
In the of the ones you mentioned, very clearly in asset management and in the research around that.
Okay, good. And then obviously yourself, you're the chief investment officer, right?
Yeah.
Okay.
That's my role here.
And then second question, how do you buy it? So often I'm listening to investment interviews or people talking, in many areas, and a very simple question comes as, well, how do I buy that? I like what you're talking about. How do I buy it? So how does one buy what you do, Garvin?
Simplest way is just to buy the mutual fund that we manage. Its ticker is NEXTX, like Next X, and it's on all the major platforms. So if you have a Schwab account or Fidelity account or E-Trade or what have you, you can easily buy it. And then we also do manage a series of separate accounts. So if you're interested in one of those, you should drop us an email and we'll be happy to talk about it.
Okay, great. Thank you. And then going to a motto or a strap line. So I found you interviewed, I can't remember where this quote is from, but it describes how you founded Green Alpha in 2007 on the premise that smart investors should be putting their money in the next economy, post-carbon companies. And you believe they'll ultimately win as climate change becomes more acute and renewable energy is cheaper and more plentiful. I found that to be a really useful description that you'd obviously given the journalist. But is there like a one sentence motto or strapline that you use at Green Alpha?
Always invest in the solutions to system level risk. Never invest in the causes of those.
Okay. Let's lock that in.
That's about as simple as I can make it, I think.
Yeah, no, that's great. So then onto the portfolios that you offer at Green Alpha, and you can clarify which ones you manage and how you allocate the work. But I flagged Green Alpha. There's a fossil fuel free. There's a Next Economy Index. There's a Growth and Income. There's a Sierra Club Green Alpha. Next Economy Select. So I counted 4 or 5 there. Is that?
Yeah, that's right. Quickly to clarify, they're all fossil fuels free.
Okay.
It would hardly go with my philosophy of fixes of causes of problems don't have value and then own fossil fuels. So no, they're all fossil free and they all fall out from the thesis of Next Economics.
Okay.
And that they all come back to our founding vision that addressing planetary scale systemic risks, requires redefining how equities are managed.
Okay.
And so we realized we would need to stop worrying about tracking error or correlation with the benchmark and just go right after what's going to fix our problems. And so our universe of companies, we call it the Next Economy universe, is represented by the first strategy you mentioned, the Green Alpha Next Economy Index. There's about 140 companies in it. And all the other strategies you mentioned are different subsets of that are designed to meet different investment goals and line up slightly differently.
Okay, I must give you a shout out to your work with the Sierra Club back in the day. When I did my master's thesis at Villanova Business School, we did a paper that with my professor and another professor. And eventually it got published in the Journal of Business Ethics. And we'd looked at the interrelationships between investors and NGOs And we used, what you were doing with Sierra Club. I guess this would have still been in the forward days because you launched in 2007.
Yep.
So shout out, and it does show up in the academic literature dating back to 2004. I'll send you the link.
I would love to read that. I can't believe I didn't know about it till now.
There you go. Yeah, this is why we had these conversations at last.
Yeah. No, I'd love to read that. Because that was an interesting strategy. That was before we developed Next Economics. So it was the kind of older, more traditional model of grabbing an index and negatively screening it.
Yeah.
So it was negatively screened SPX.
Yeah.
Tough criteria, eliminated 80% of the names.
Yeah.
And then the resulting 100 formed the Sierra Club stock fund. But that was us just getting warmed up.
Yeah, exactly. Yeah. That's good. And I want to unpack some more of that. So let's talk a bit about Green Alpha's investment philosophy. So I'm quoting here from the Green Alpha Growth and Income Strategy. It's a great name, by the way. It almost deserves to be on a pub or something. It's like, the haggis and lettuce or something. It's like the growth and income. Well, welcome in, help yourself.
Well, maybe we should found that.
Yeah, I would, if you own a coffee shop ever related to, Green Alpha at head office there, you got to call it, something like that. So it says the Green Alpha's investment philosophy is straightforward. Don't invest in companies that cause global systemic risks. Instead, invest in the smartest, most rapidly evolving, economically competitive solutions. We expect such companies to gain market share, which makes investing in them our best chance at preserving and growing our clients' purchasing power. Well, that's a powerful sentence. I mean, Kathy Wood is probably going to be happy with this sentence as well, right? Any marketing person, frankly. So talk to me a bit about how you landed on those sentences to describe what you do.
We realized that there is a lot of confusion around what impact investing is and what it does and what its goals are. And we realized that stems from the fact that not everything labeled impact is actually having impact. So in turn, it comes back to our reasons for founding the firm that I mentioned a minute ago. And that is, well, what are we trying to actually accomplish here? Is it to have a correlated strategy that's a little bit more green than business as usual? Or is it to point capital at what an indefinitely sustainable economy can and will look like? And we very much decided on the latter. And the more we developed our thesis and the more we thought it through, the more we realized that not only is that the way to have maximum impact with your strategy, but it's also the most clear path to long-term competitive returns. I think if I were going to borrow a phrase from, hedge fund speak, I'd say the winning factor now is to find the smartest, most economically competitive, most scalable solutions that exist in the world that you can buy with public equity exposure today, and then own as much of those names that own the majority of the IP for how to solve our problems competitively and the most productive capacity for how to solve those problems. And I think that not only is that going to be a good way to, again, actualize real impact with your strategy, but it's going to be the clearest path to long-term competitive growth because, like we were talking about during the numbers round at the beginning, as global GDP crosses 125 trillion a year, if that's on a high carbon business as usual basis, like Nicholas Stern said, we're going to self-destruct.
Yeah.
So it has to be that growth entirely on the basis of a solution set, meaning that's the only place to look for gains. I think the IP around how to fix our problems is going to maybe ultimately be one of the few things that does have value. And not owning that is a big mistake.
Yeah. Yeah. So let me be a bit cheeky and go off script here. Now I'm picturing happy days in Colorado. I've got mates in Boulder who train triathlon and. So I'm going to pitch you, can't we buy into gravel bikes? I'm going to pitch you, Garvin, please, would you buy my gravel bikes company? Because we need more cyclists, healthier. We solve the health and obesity problem. I want to go long gravel bikes. Why is that not going to show up in your portfolio?
We'd have to have a conversation about it. I would legitimately put that through my investment process before I dismissed it out of hand. and the top level heuristic on a go no go for possible inclusion into our strategies is this company doing more to fix our problems? Is it doing more to stabilize the world or to destabilize the world? And I think that's best reflected by source of revenues. And I think that if you're earning the majority of your revenues doing something to stabilize the world around climate, around resource degradation, around worsening inequality, it could be around human disease burden. So this is where climate and disease burden are where the bikes come into play.
There you go.
So if I thought it was scalable, if I thought it had defensible IP, if they were doing it better than any other bike shop on the block, in an intellectual property defensible way, and it therefore was going to scale and provide great returns for my clients, I'd have that conversation for sure.
I think we just launched Gig Bike, Growth and Income Gravel Bikes, Gig Bike.
I'll be a investor and a customer. The trails around here are wonderful.
Yeah, they are. I do remember that. Okay, so moving forward then, I want to have a little time on the deep dive look at the Sierra Club Green Alpha, and I'm pulling from one of your notes here, end of last year. So it describes a blend of Green Alpha's forward-looking next economy research process, which you described, and the Sierra Club's proprietary social and environmental criteria applied to each company's operating history. Looks like you got 30 to 50 names in the buy sets, fossil fuel free, all cap global equities. Could you unpack, again, it's one of those triple digit returns, and we'll get to performance a bit later, but yeah, a happy year in 2020, clearly. But talk to me a bit about how you take your process and then you've got to work with what Sierra Club wants you to do. How does that work out?
That's exactly how that portfolio is constructed. We start with our next economy index, as I mentioned, 140 names that we think represent fantastic long-term solution sets. And this is the only product that we have that does employ any negative screening at all. And in order to wear the Sierra Club brand, one of their requirements, and this has been true since way back in the forward days, every potential investment needs to pass their criteria. They've got tough criteria. There are 30 of them. And they cover everything from, as you might imagine, emissions to sprawl to green fielding to you name it, and then social stuff too, like OSHA and labor. So what we have done is taken our next economy universe, which again we already think is a really great solution set, and then put it through their negative screening process, and the resulting set is both a forward-looking via next economics and a backward-looking via negative screening, a very, very highly scrubbed list of sustainable companies. Okay. And so, and that really is the construction process. And then the sizing on each company depends on our conviction around it. But yeah, there'll be about 40-ish names on a given quarter, and we think that they're not only very interesting going forward, but they've got really squeaky track records on the backward-looking basis too, which is where the club's criteria come into play. And it's one of our, we love all of our strategies, but it's one of our more interesting strategies on that basis. You really get that negative screening aspect in it, overlaid onto what we already think is a very green strategy. So it's double green, if you like.
Nice, very good. When in part 3, when you talk a bit about engagement, I want to pick up a thread on that front. Okay, so let's move forward then. You describe in your ADV, I filled out the investment thesis that you have. I mean, some of it, this quality material here, too much to read out. But let me just grab a piece of it. Companies that aim to uphold or enhance these, and above you've described kind of tackling sustainability issues. These essential underpinnings are not just doing a public service, but are finding opportunities to generate long-term revenue, thereby contributing to economic growth. By creating innovative solutions to system risks, next economy companies drive the development of a generally, quote, sustainable, unquote, economy. As a result, Green Alpha believes solutions-focused investing is also the clearest path to competitive returns. So you talked a little bit about that, but maybe you could unpack it one more layer down for us.
Yeah, I think going the next wonky step down is what I'm trying to do is figure out what's going to enable the human economic production function to work phenomenally well indefinitely without overtopping planetary tolerances, right? And then, like I said, to own as much of the related IP and production capacity as possible. So as these innovators gain market share away from their more destructive predecessors and counterparts, their revenues and share prices are going to respond accordingly, right? So as the transition continues on whatever timetable, hopefully faster, but faster or slower, the legacy economy is just going to underperform the next economy. It's on that basis that we think indexing has now become a bad idea, because that optimizes on the past, right? It's, well, which 500 companies have constituted the 20th century? What has won the race so far?
Right.
And I think that in a time of exponential change, which we now clearly live in, both in terms of innovation curve, you mentioned Cathie Wood, that's her whole thesis,
right?
But also in terms of the planetary risks we confront, also on a hockey stick-like trajectory, unfortunately. Between the two of those, we very, very clearly live in a time of exponential change. And I think during a time of rapid change, optimizing on the past is a terrible idea.
Yeah. And so that leads me to got one more question. And then there's a spicy comment in one of your pieces that I want to reference. No, it's fantastic.
Oh, what have I said?
Yeah. So quick question first, though. Carbon footprint analysis. And this is a common question I'm asking all my guests. Does your organization or your approach conduct carbon footprinting, temperature mapping, and or climate scenarios modeling analysis?
We haven't engaged in that. I can see the benefit. So in terms of carbon footprint, on an individual investment level, on a stock by stock level, we run the other way from carbon intensity, because we think anything very exposed to the carbon economy is going to have a very hard time going forward. We not only are fossil fuel free, we don't like demand drivers for fossil fuels. Like some ESG darlings, such as Toyota, we have just never owned, because they're notoriously intransigent on the idea of building an EV. Right. And meanwhile, they build 10 million ICEs, internal combustion cars, every year with an average fleet MPG of something like 26 because of all the trucks. This is directly causing the climate crisis. Right. If I bring it back to thesis, they're doing more to destabilize the world than to stabilize it. And therefore, I judge that they aren't going to make a fantastic long-term investment. Right. So anything exposed to the high carbon economy, we just don't own. And so therefore, we haven't really gone to the trouble of doing a CO2, equivalent per, dollar of revenue analysis. I suspect that if we did, it would be really, it would look great. There wouldn't be much there. And then in terms of our own internal operations, we just honestly, we haven't gotten to it. We're still pretty small and we just haven't done it. I think it's a good idea. We don't burn much carbon. We're just here in an office. We run a few computers and, we have a Bloomberg terminal and such, but that doesn't mean zero carbon. We're on Excel Energy here in Colorado. They've committed to be 100% renewable based by the end of the decade. Until then, we have some carbon exposure. We should probably do something to mitigate that.
Yeah, fair enough. So here's that spicy comment.
All right.
Well, I think it's from your it's from Green Alpha Advisors, January 2021. So I think it's like a presentation deck or something. It says, quote, conventional environmental, social, and governance ESG criterion are meaningless if a company's product and service mix does more to cause risk than solve for it. So ESG business model measurements must be assessed after a company's revenue mix is deemed to be positively impactful, because the time for marginal impact has long since passed. Bam. That's a shot fired, sir.
That is spicy. Yeah, unpacking that a little bit.
Yeah.
I think we here would agree that ESG criteria are meaningful, but after the assessment of whether a company is doing more to stabilize the world or to destabilize it, right? So in the case of Toyota, I don't care what its ESG score is. So on that level, that's meaningless. I'm going to just dismiss that out of hand. It's causing the climate crisis. To be a fossil-free strategy and own that company is like being, an alcohol-free strategy. And so you don't own a distiller, but you own every pub and distributor you can get your hands on. Right. It's a little bit crazy. All those fossil fuels didn't burn themselves, right?
Very common.
And so, and similarly with Exxon, I know that your background is in some ways related to MSCI's ESG practice, but currently they have a triple B on Chevron and Exxon.
right.
Which means they're perfectly acceptable for ESG strategies to buy. That isn't their highest ranking, but it sure is fine.
Right.
And so I don't need to know that. For me, that score is indeed meaningless because it doesn't pass my top level heuristic. Now, of all the companies that do pass that I can convince myself they are doing more to solve than to cause our big risks, then I do care very much about ESG. I want there to be employee ownership. I want there to be diverse representation. I want there, all those wonderful ESG parameters do come into play then. And in terms of our portfolio construction, they do inform our conviction around a name.
Right.
We will turn the sizing up on better ESG companies. We will go longer. We will be more convicted around them. But I don't care about their ESG unless they're doing something to help stabilize the whole place.
Okay. So fun response and then a serious response. Does that mean you would never have held Ben & Jerry's because then we'll have to end the interview because that's horrendous?
I've held it individually back before it got bought out. But no, we've never professionally owned it. I haven't ever owned it on behalf of clients. But that is a great question.
We are going to march with our ice cream cones at your office after this call. So.
Oh my gosh, can I have one?
Yeah.
I'm a huge fan of Tonight Dough.
Sorry, yeah. So then the serious question is, there's a challenge because companies have more than one business, they're commingled effectively, yeah. And every company's got some better parts and some less good parts. So something that I'm putting in front of people now, and I've been thinking much on, is the New York State wind farm allocation, wind turbine offshore, and the development project was won by Ørsted in joint venture with Equinor and BP. Right. So I get fossil fuel free. I get that most revenues for BP for the foreseeable future are going to come from polluting things and making them worse. But I'm as interested in, but to your point about the best of a bad lot, right? So understanding you won't touch it, but when does it turn enough? Or what would be the earliest time it would be on the long list that you'd possibly start to look at an energy company that clearly and explicitly, contract by contract, you can see what it's doing? Is that a fair question?
That's absolutely a fair question. And a lot of our discipline here is in constantly checking our biases and constantly questioning our priors to think through if we are still on the right track in terms of an empiricist view of what is going to help us get to that end game of indefinite sustainability. And this is why we've decided that source of revenues matters more than ESG score, at least in terms of your top level cut. So on the long list of stuff we're looking at, those names are already on there. And for a couple of reasons. One, I want to keep my eye right on the progress they're making and to what extent I think it's genuine as opposed to greenwashing, say. Yeah. And two, because I'm interested in interrogating their suppliers and their downstream companies to see if I can find some interesting ideas there. Because there are many interesting names that might be associated with that supply chain that aren't BP per se, but that maybe say supply the advanced materials that constitute those turbine blades. Right. That could be very interesting, right? So the long list, they're already on there.
Yeah.
Now, the investable list, that's something else.
Yeah.
And in that case, I need to convince myself that they're getting paid to fix things, not to break things.
Okay.
Which means that more than half of the revenue better be coming from the fixed side.
Right.
And we haven't broken that yet, at least as far as we know or could ascertain.
Okay.
Asterisk disclosure.
Yeah.
But I think if I ever did, it would be because, like you just pointed out, they're getting close. They've got a plan. You can see the revenues beginning to shift. This is still a hypothetical, asterisk. But think about Volkswagen.
Exactly. That was my next example. Right.
So
they've had a great Q1, right? And part of the thesis is they've just launched ID4 in the US. They've got a much larger one in China already. And So yeah, what is your thinking on VW?
And look at their commitments. They want to be 100% EV based much sooner than any of the other legacy OEMs for internal combustion. And they're putting up the investments to demonstrate that, including their big investment in QuantumScape, so they can be one of the leaders in solid state batteries. Dietz has said, that their CEO, that he's explicitly modeling Tesla's business plan. You could say that's copying. I don't care. I think that's a great idea. Tesla's been ridiculously successful. I think they should have done it a couple of years ago, but they're doing it now.
Sure.
And in some ways, they're even attempting to leapfrog Tesla by going straight to solid state batteries, which have the potential to become cheaper and have longer range and charge faster. Right. So this is interesting to me. And when I can see a very clear, demonstrable path to they are going to be doing way more to provide zero emissions transportation than they are today, I can see putting them in there, provided all the other stuff asset managers need is there, the fundamentals and such. But they're on the list. I'm staring closely at them. I think among the legacy automakers, they are far and away ahead.
Okay. Yeah.
Other than that, our auto exposure is Tesla, is NIO, the pure plays.
Yeah, fair enough. Okay, so let's wrap part 1 of 3 in the deep dive, and a question on CO2 equivalent pricing. So what price for CO2 equivalent per ton does your firm use internally for your operations today? And what price are you seeing in your portfolios?
So these are basically going to be the same answers I gave you on the previous round, but we don't set one here at Green Alpha, although we just don't use much energy or have much, especially in the last year and a half, we haven't traveled at all. So we don't, although I don't think it's a bad idea. I think my co-founder, Jeremy Deems, he's also our CFO. He's our recovering CPA. So he stares at the nuts and bolts all day. I'm not sure he'd love taking on that assignment, but he would be interested in it. And I think that would be very interesting for us to figure out and then mitigate to the extent that we can. And then on the portfolio level, I'll repeat that we haven't actually really bothered because we want to be so far from exposed to the fossil fuels economy that we aren't caught in that downdraft as it unwinds. We've done it for performance reasons, but I also think it means that you could speculate. We haven't done it. I don't have a number to share with you, but you could speculate that we're only exposed to things that assume a very high carbon tax.
Right.
Like, again, I won't even own Volkswagen today. I won't own GE because of their wind power business, because the bigger part of their business is making that gas turbines still. Right. Forget it. I won't own it. And I think that implicitly assumes a very high carbon tax.
Understood. Great.
You are listening to the ESG and Coffee Podcast on Investing, Strategy and Sustainability. 您现在收听的是 ESG 和咖啡时间，投资策略和可持续发展。
Great. Okay, grab a sip of that delicious coffee. We're going to go to round 2 of our espresso shot questions. 5 questions. There is no wrong answer. You ready?
I'm ready.
What app are you most likely to be viewing on your smartphone while waiting in line?
Oh, I'm either, if I'm waiting, it means there's a little bit of downtime. So I'm probably trying to hear something that will inform me. So I might be staring at my podcast app, or I might be looking at my Whoop app. I don't know if you know about Whoop, but to see how well recovered I am.
All right. Okay. Good. I like the numbers game. What book did you enjoy reading recently?
Oh, I'm kind of a sci-fi nerd. Okay. And so I really liked Kim Stanley Robinson's Ministry for the Future. You've probably heard that from a lot of, so that's both a sustainability nerd and a sci-fi nerd rolled into one. But it's like Robinson wrote a novel of next economics. So that was kind of cool. Nice. It's like he novelized our thesis, and I loved it. Yeah. But I also like to expose myself to some different cultural takes, just to try to be rounded. So right now I'm in the middle of I'm currently liking Indian author Ashok Banker's Upon a Burning Throne.
Okay.
It's been kind of interesting.
Oh, okay. We'll drop that in the show note. Thank you.
Cool.
What is the best kind of pie?
I'm a sugar fiend. I like all the pie.
Okay. Good. My daughter would like to meet you.
I'm sure we get along.
We call her the sugar sniffer, and she literally can find sugar. Yeah.
Wow, that's amazing.
What is your favorite movie or on-screen moment that relates to the world of investing?
So this is not a movie, but it has appeared on screens. I hope cartoons are acceptable.
Go ahead.
I like the scene in The Simpsons where Homer goes to his stockbroker because he's recently had a big unrealized gain on a position, and the advisor says, "Homer, you doofus! I've told you 100 times you've got to sell your pumpkin futures before Halloween. Before." I like that just because it's funny and because it resonates with me, because if only self-discipline was that easy.
Yeah, no, very nice. That's a great anecdote. All right, final of this set of 5. As an investment professional, what was your most meaningful success so far?
Well, I don't know how much success we've had with it yet. A little, I hope. But I think it's moving the industry's Overton window in defining investment risk. Like I said a minute ago, the scale of our threats now means we have to change how equities are managed. We just have to change that. We can't correlate with the old-timey benchmarks anymore. And as far as we can tell, we were the first managers to embrace that via our next economics theory. And cycle after cycle, it's been working. It's been unfolding well. I think that's meaningful.
Okay, wonderful. It's so amazing to have started something. So I really appreciate that about you, over all these years. And that's why you're in season 1, the originals.
All right. Well, I appreciate that. Thank you.
Nice. All right. So our second of our 3 deep dives. Here we go. The sell discipline. You just referenced it earlier. For me, it's really a defining characteristic. And if I'm only, I've got a budget of questions I can ask, I'm always looking to ask an investment person, what is your sell discipline? That's the hard thing. Quoting from your materials, it says, we sell when fundamentals of the company deteriorate, industry shift, management execution, quantitative characteristics become less attractive. Second bullet, the company no longer exhibits characteristics of the new economy business model, merger acquisition, business evolution, technological obsolescence. And then final bullet, valuation is deemed unattractive after balancing industry-specific valuation metrics with stock-specific growth expectations. I mean, I'm going to pass you through my MBA class right now because that's well put. You want to unpack that a little bit for us?
I really threw the kitchen sink at that one, didn't I?
Yes, sir. Yes. That's called a complete answer. Yes.
Well, hopefully any gatekeepers, who read that will think, okay, they have a sell discipline.
Yeah.
I think that a little bit more down to earth way to put it might be that, we don't rely on price targets or return targets. If something's up 100%, that doesn't trigger a sell. If something has hit share price, XX, that does not trigger a sell. What we care about is the potential for the company to keep growing into its market and to keep growing in absolute terms. And mostly there, I care about ability to grow revenue and expand margins, not as much about earnings, because a lot of our companies are growth phase, and hopefully as their revenues grow and their margins expand, they're plowing more and more back into things like R&D and increasing production capacity. Mm-hmm. So as long as there is every potential for them to keep growing and expanding into the future, which again is core to our whole thesis, then I don't feel a particular need to sell, no matter what their purchase date to present return has been. So we think of it very much as fundamentals based and then also TAM based and market growth based. So it does involve a little bit of forward speculation.
Okay. And to clarify, you said TAM, tactical asset. No.
I'm sorry, a total addressable market.
Got it. Okay.
So if I think about, say a wind energy company, I don't know, I'm just pulling out an example. This market is growing. It is gaining market share away from coal and gas hand over fist. So if you're a moderately successful player with a couple of % of the global market share, we don't own that. We like Vestas, which is the dominant player. We like a couple of others. Yeah. But okay, say you're Vestas and you've got a pretty big chunk of the global market share. Well, even if all you do is maintain your market share, you're in a growing pie situation. Meaning you've got every chance of continuing to grow your revs. And as long as they're additionally, and this is what I meant by the part about fundamentally management fundamentals and their ability to execute. as long as they're using that growing rev to keep increasing their production capacity so they can keep growing revenue, then I'm still interested. And I don't care if it's up, 400% over the last 5 years. I'm going to keep owning that.
Okay. That's really interesting. So one of my follow-on questions was going to be, so how would ESG performance trigger the sell discipline? So you've been clear on kind of the business needs to be in the right direction. ESG is the minor for you, but what pieces of the ESG would trigger a sell discipline?
We recently, just for compliance reasons, because we're in the middle of trading this name now, but an EV supplier.
Okay.
We recently decided to get out of across strategies, and we're in the middle of that right now, because traditionally they've been sourcing their revenue 80-90% from making EVs and supplying electric vehicle parts and components to other EV makers. But then over the last couple of years, they've started adding this ATV business, this off-road business that isn't based on EVs, but rather traditional four-stroke engines. Well, when that was 3% of their revenues, I kind of let it slide. But as of their last quarterly report, it had risen to 40% of their revenues. Wow. That doesn't fly anymore. For me, that's a big ESG whiff. They're betting on the wrong pony. And they're exposing themselves more to the fossil economy going forward. And that's just not anything I'm interested in owning. So while their fundamentals may still be okay, that's not something on a sustainability basis. So you could call that ESG. It's the E in ESG. That made us kick it out. Okay. And we're in the process of divesting now in hopefully in a way that is a nice appreciation on the price target for us and our clients. But it's got to go.
Okay. Wow. Interesting. So again, being mindful that legal and compliance will come take your coffee away. We don't want that.
Oh, they can try.
So could you talk to, I looked at your quarterlies. Could you talk to Moderna, obviously topical vaccine, and God bless the scientists who work super hard and all the many healthcare workers who've helped, get those vaccines out, and respect to all of them and so on. So could you talk to Moderna, and then if we have a little bit more time after that, maybe TPI, the composites business? Yeah.
Yeah, happy to. It's funny because I was sort of talking about TPI when I was talking about advanced materials for wind blades.
Yeah,
you caught me. Moderna. So, we want the world to be more stable, not less. We think that solving the big system level risks is the clearest path to competitive returns. And we think that the companies that own the IP for how to do that are the ones that are going to do best going forward. So on that basis, we added Moderna back in 2019 to several of our strategies about mid 2019. So obviously, the catalyst of the pandemic has been really good for our returns. We didn't see that coming when we bought the stock, obviously. Right. Nobody had really seen it coming yet in mid 19. But the basis for that buy was that we have just seen a revolution, a genomic revolution in the world that is, in my opinion, inestimably important. Yeah. And gene editing and other means of using both mRNA and DNA, and then of course they go together because mRNA is how we code our DNA, right? To affect phenotypic changes in the human organism to do therapeutics, but also vaccines, obviously, and then in other organisms as well. So it's going to have applications in agriculture and advanced materials and biofuels. And it's going to do so much to make the planet more sustainable that it's just so important in ways that we can't imagine yet. Like Graham, if I were to go a little further on this divergent tangent, I'd remind us that in the 70s, Gordon Moore thought that the integrated circuits he was designing, he thought that their best use was going to be better calculators. Yeah. He didn't foresee the ridiculous uses we put ICs to. Similarly, we can't foresee how important the genomic revolution is going to be. And so we went looking for a basket of names that owned the IP for how to best actualize the genomic revolution. So we did buy a small basket. We bought CRISPR Therapeutics, we bought Editas Medicine, we bought Moderna. One where I'll circle back to your question about a mistake is we also looked at and approved BioNTech. Didn't add that one to our basket. Big mistake. When something makes it through your process and you are sure that it's a great stock, just buy it. We expected to earn, it's all about time frame, right? We expected to earn nice returns on Moderna over about 5 years as they got through different phases of trials for their various therapeutics and vaccines. And they've got 25 things in the pipeline that we know about.
Right.
And we expected to have a nice, 5-year return on that. We didn't expect it to be a nice 1.5, 2-year return. The pandemic was a catalyst that, of course, we didn't see coming, but it just does go to thesis that solutions to problems and the ownership of the associated IP can have tremendous value, especially when it's solving, as I just said, our biggest problem. And in this case, it's human disease burden. It was the proximate catalyst, but the ultimate catalysts are going to be things like, tank grown algae that are rapidly convertible into high grade aviation fuel, or, things that batteries aren't going to solve. Right. Okay. So I think it's going to be a wonderful holding. And that also leads me to sell discipline. So it's obviously up a lot in the trailing, 1.5 years. We still think it's to use a baseball metaphor, about the bottom of the first for that stuff.
Really? Wow.
Yeah, oh yeah.
Okay.
Yeah.
Oh, nice.
And the other one's in the basket too.
Okay. All right. Let me wrap part 2 deep dive with again a standard question I'm asking all my guests. Do you agree greenwashing is real, and how does it hurt the work that you do?
Unfortunately, it is. And I'm not sure some of the practitioners themselves would agree. I think that they may imagine that they're doing the best that they can, but it is disheartening to see major fund companies have ESG branded strategies that hold, coal and tar sands and pipelines, things that are visibly destabilizing the world. That's, to my definition, that's greenwashing. And the problem with that is it does hurt our work. Your follow-up question, the answer is yes, it does, because it dilutes what we're trying to do. It confuses the messaging. You recently had BlackRock's former head of ESG come out and say ESG isn't going to save us. Well, the way that BlackRock practices it, he's right. I've been asked the question, can you even have impact on the global economy with ESG for the better? And, I think people are fair to ask me that question, because so many ESG branded strategies don't have much. It isn't that stock investing can't have impact. It's just that it usually doesn't. And therefore, or at least positive impact, I mean. And so on that basis, I think it makes people cynical and skeptical, and they might even just decide to give up on the whole idea. So I do think it's damaging, and I do think it's a problem. I wish that, I'm aware that you believe, and like so many other folks have said, that there really need to be rigorous standards around ESG, or at least reporting and what that actually means. Right. If there were agreed upon, if there was a gap, or a FASB around really strict criteria about what various stages of ESG mean, it doesn't have to be one thing. It could be 10 different things. Right. There could be everything from what we do, like don't be exposed to the carbon economy at all the way to what BlackRock does, holding coal in their ESG funds, and you could pick your flavor, but at least it would have a firm definition. Yeah. If we did that, I think it would do a lot to allay people's concerns, but I'm afraid we're a long way from that.
Okay. So useful comment. Thank you.
You are listening to the ESG and Coffee Podcast, hosted by Graham Sinclair.
Right, grab another sip of your coffee. We're about to hit our third fast espresso shot question set. Are you ready?
Mm-hmm.
Here we go. There are no wrong answers. Do you have a favorite type of tree, and what is it?
In the house where I grew up, in a quiet little suburb of Salt Lake City called Holiday, we had a huge century-old cherry tree in the backyard. And as a kid, I would climb up there and just feast on cherries, and that's still my favorite kind of tree.
Fantastic.
Big, beautiful old tree. Loved it.
What one book on investing would you recommend?
Oh, geez. Well, I think that to understand well our problems, we can better see the solutions, and that leads to better investment decisions. So if I were to limit to one, that'd be hard, but I'd probably start with The Meaning of Human Existence by E.O. Wilson, because that reveals what motivates us, why we do what we do, why we are what we are. It's like the ultimate behavioral finance book, even though he didn't write it that way, right? But if I could sneak in a second one, Annie Duke, her book, Thinking in Bets.
Okay.
It's on how to avoid your biases and continually re-examine your priors. She's very bright on those topics.
Yeah, she would make a great guest in some future season, which I haven't figured out how to frame yet.
She would.
How is your own retirement fund invested?
Oh, 100% in my own strategies. No exaggeration.
There we go.
In fact, we have one that we're incubating that we call High Conviction, that's very concentrated.
Okay.
And we haven't rolled that out for consumption yet, because I am incubating it, but it's what I think all of our best ideas are, and that's where I got about half of my own retirement.
Wow. Okay. We're gonna need some of that for our gravel bike strategy. We'll talk about that offline.
Maybe they can go public via SPAC and I can get some.
Oh, there you go. What would your advice to your 17-year-old self be today?
You're doing great, kid. Stay the course. No, I mean, really, it would probably be the banal stuff anybody would say. Work a little harder, study a little more. I don't know.
Yeah. Okay. Drink more water. Yeah. One of those.
Yeah. Drink a lot of water.
What is your advice to people seeking to enter the field of ESG investment and finance tomorrow?
Don't worry too much about the conventional wisdom of investing. Don't worry too much about all those textbooks you're going to be handed about modern portfolio theory. Correlating with the benchmark doesn't matter. Follow your own guiding star about what investments are going to work and on what basis. Think about every stock you are going to buy like a private equity investor would. Evaluate every one on its own merits for what it is and not the portfolio level impact it's going to have. That doesn't matter anymore.
Very, very interesting. Okay, so let's kick on then to deep dive 3. We're running late, but it's a great interview. I'm happy to keep rolling.
I can keep going.
Good. So performance, and I know you want to keep going because this is your happiest smile I've seen. Last time I spoke with you just on the phone, but now we're talking and I can see your smile. And of course you would have a smile because I didn't know this till I was researching for today's interview. And you are a triple-digit fund manager. Yeah. Now I'm mindful. I will throw a bit of history at you. Peter Kinder, the K and KLD, leading ESG research shop back around the turn of the century, indexes as well.
Mm-hmm.
One of the things he said to me in 2005 when I was catching up fast on what is happening in the industry, he said, Graham, remember we'd go for a bike ride sometime along the Minuteman bike path out of Boston there. And he said, Graham, never sell performance. Because you can sell it today and it's fantastic. It will change and down the line it's going to bite you. And whoever you sold it to, they're going to come and hold it back in your face. Sell process, sell philosophy. And we were just selling the ESG research to different types of investors. So I want to do 2 things. I want to celebrate a great year for you and good on you and your team and so on. It's I think 113.9%, let's call it 114% 1 year returns, not 10-year returns. But your colleague, Jeremy Deems, and yourself, you had a good run. So that's to be celebrated. But then what is your kind of sanguine take on, the happy and unhappy parts of performance and the fame it creates and what happens next?
Well, first of all, thanks for noticing. 2019 was great, and I would have been more than pleased to duplicate that in 2020, much less have the accelerator that kind of came with the pandemic.
Right.
And Peter Kinder, 100% right. Do not sell performance. That's crazy for any manager, much less one like us that has made the very explicit conscious decision to be uncorrelated. When you're uncorrelated, that means you're either going to be far above your bench or on occasion far below it. We have had both in our history. And we've been very fortunate to have been on a very good run the last 8 quarters. Our last quarter of significant underperformance was Q4 of 2018. Mm-hmm. But that was a bad one. Mm-hmm. And so Peter may have told me that too. I've known him a little, I didn't work with him, so I don't know him as well as you do, or I'm not as close with him as you, but I've chatted with him on several occasions, usually to the conference over a beer after hours.
Right.
And so I don't know if he told me that or not, but it's 100% true. And not only that, I think it's not only will it come back to bite you, Peter's right, but it's not the point. The point is to put boundaries around what you think the probable outcomes for the global economy are, and position yourself in the best possible way to get in front of those, and therefore give yourself the best probabilities at competitive long-term returns. Right. And so the day-to-day performance from that point of view doesn't matter, or it doesn't matter much. It matters to me in terms of finding entry points, though, I guess I should say. So I don't really like the news coverage that this was the top ranked ESG manager of 2020, or it was the best returner of whatever time period, because that does create hot money inflows, which I just know are going to go back out. And so I find myself having to plan in advance for, well, okay, when this hot money goes out, when we have a tough quarter, what am I going to sell? I hate that, because we're long-term buy and hold.
Right.
We're very tax efficient. We're very low turnover. I don't want to have to sell and disadvantage all the long-term holders to satisfy the hot money. So I wish people would buy us just on process, but that's not the real world. The minute, you've got 5 stars, you get some money just for that.
Yeah. This is why my podcast is not just about investment. It's the business of investment, right? And some of this is that big overlap there. Good. Thank you. Thank you very much for that answer, Garvin. Right. So moving forward then, engagement. You got a very concentrated portfolio. That means, and you referenced already kind of the private equity approach. Private equity is the asset class I've seen the best ESG engagement on some previous work I've done. But what is your approach to engagement? Do you engage with companies? I've had another guest say, we actually don't talk to companies. We don't want the human touch bias. So everything's at arm's length. Do you engage with companies?
We don't really. On the asset management level, we do. We will talk to management or IR about questions we have.
Okay.
So in some ways, this is engagement, because we can point out things that we would like to see that would give us higher conviction. So that is sort of a soft form of feedback for them. For one, a sustainable financing company, sort of a differentiated financial by categorization. They're all about financing wind and solar projects and like building retrofits to make campuses more efficient and such. And I just kept hammering them on, well, would any of that ever involve a gas boiler for a building? Or would any of that, or do you believe in cogen perhaps with your solar plants? Because if the answer to that is yes, I'm not nearly as interested. Right. So on that level, our management engagement to ask legitimate investment questions could be perceived in some ways as some advocacy work. And then the other half of that, but otherwise no, the other half is we're pretty aggressive with our proxy voting.
Yeah. Okay, great. And that's what I want to pick up on next. And happy to have you explain it in more detail. And then one piece I'd definitely like you to discuss, I picked it up in your form ADV from back in 2018. It said, quote, if a client is interested in directing our vote in a particular solicitation, we encourage our clients to contact us so we can work together to facilitate such a request, unquote. And I'm not sure if that's standard wording. I have not read that. I'm not an exhaustive expert on ADVs, but I haven't seen that framing exactly like that. So happy to hear what your approach is to proxy voting, and if you can cover that as well, please.
Sure. So our proxy approach started back in the Sierra Club Stock Fund days. We retained Glass Lewis to help us build a really rigorous set of guidelines that we pulled in as we would have had to at that time, because we were operating under their mandate and with a fund branded by them. We pulled in the Sierra Club to help us with that, and we ended up with a 100-page document of guidelines about how to govern almost any proxy decision that may come up.
Wow.
And
publish that as a separate item.
Maybe we should. We
historical artifact, right? It's like best practice in 2005, whatever.
Yeah. Well, so we were fortunate to be able to work out a deal with Forward Funds when we left there to found Green Alpha, to be able to take that with us. And the CEO there at the time was okay with that. And we did do that. And since then, on our own and in cooperation with the club, and very occasionally on the basis of input from separate account clients, we have been updating it and modifying it ever since, right up and it, because the world just changes so fast. You can't just let it sit the way it was in 2007, right? So we've been updating it frequently. Like, for example, can I give an example?
Yeah.
Well, I know we're already over.
No, go ahead.
Well, so we weren't the hugest fans of GMOs.
Yeah.
And because primarily, especially at that time in the mid-late 2000s, they were primarily being used to gene hack crops so that the Midwest could be carpet bombed with glyphosate every year to maximize yield. Well, this is obviously terrible for topsoil and for water and all the resource degradation things that we think are, pushing us towards the planetary boundaries that just will not be sustainable. So, okay, we didn't want GMOs on that basis. Well, okay, but now you just heard me talk about how I'm a huge believer in the genomics revolution. Well, what is genomic editing but a massive genetic modification? So now I perceive that so many of the use cases are positive that we need to just get over being anti-GMO and realize that we need to take every modification on a case-by-case basis. Right? So proxy guidelines completely overhauled.
Wow. Okay.
And that just had to be how it is. You have to update your priors. Any Duke would totally agree with that.
And did you have any clients come back on that? Because I would think the communication, I mean, that's a sensitive issue, right? It's a front page issue. I mean, so some client might have reacted. How did you communicate it?
We got surprisingly little feedback on that. We did have a couple of clients ask us about that were just very strictly no GMO in their own mindset. And in one case, we talked it through with them. We got on a Zoom and we talked it through with them and pointed out all the positive use cases that are going to emerge from the genomic revolution. And they ended up, to their credit, it's hard to convince people out of their priors. But to their credit, they ended up agreeing with us and said, okay, we'll trust you guys to keep a very close eye on that. In the other case, we didn't end up losing the client, but they ended up disagreeing. And they were a large enough client that what we ended up agreeing to do was a custom portfolio where we would just leave those out of their strategy. But I told them, and I think the long term will probably prove me out on this. By taking the whole genomics basket out of your strategy, you're probably going to see return dispersion, and our other strategies are going to beat you. And they said, we're fine with that. We understand.
Fair enough.
Okay.
And this goes back to the business of investment, right? And so you present your best thesis, and you have to be flexible with your clients, right?
And why are they in our strategy to start with? They want their returns to outpace inflation over time, and therefore at least maintain and ideally grow their buying power into the future. That's why we invest. So the reason to do that is to own the things that are going to grow rapidly into the future, more rapidly than the underlying economy, and therefore improve your buying power opportunities into the future. And genomics are going to be a very key way to do that. And I just let them know they're leaving that card on the discard pile, and it's not going to advantage them.
Okay, so I found another spicy quote from one of your materials. So thank you for that. I'll quote it back to you here. And it's the last part of our deep dive on divestment. Every investment ends eventually. So it goes like this, quote, style drift. We didn't invest our portfolios in fossil fuels we didn't divest our portfolios of fossil fuels when it became trendy, because we never did invest in fossil fuels, unquote. So, I'm going to give that a 5 out of 5 for snark. I mean, that tweet is ready to go. Good on you for having that there. Could you give us a minute or two on divestment? When do you do the Wall Street walk?
That quote came out of we actually got a phone call from Divest Invest, the organization.
Okay.
Oh, probably in about 2013 or 14, maybe. I don't know. And I happened to pick up the phone that day, and I just couldn't help but be a little bit snarky on the phone with them, hopefully in a good-natured way. It was actually a pretty funny conversation. They said, will you take the pledge to divest all your assets today? And I said, well, we don't have to, because we never did invest. And, we all kind of laughed on the phone, and I thought, oh, we should put that on our marketing materials. No, we don't care about a divest campaign. We don't care if that is a good marketing tag, because for us, it was all about, these are the causes of a system level risk that have the potential to collapse civilization. On that basis, they make a terrible long-term investment. Again, like Lord Stern told us, any attempt to grow the economy on a high carbon basis is going to self-destruct. Therefore, I judge that over the long run, holding carbon intensive assets is a terrible, terrible investment that is not going to do well. And that's why we never invested. So divesting never came up. You can't hold the causes of the climate crisis and expect to do well. If you do that, let me just put a super fine point on it. If you hold fossil fuels or their major demand drivers, you're making an active bet on collapse. It's just a terrible idea.
I like the fine point on that. So let's wrap deep dive 3 and talk about Lord Stern. Definitely his paper coming out in 2007 will be on that list. But I'm writing a book on a history of ESG in 100 moments. Gene Rogers, from the founder of SASB, encouraged me to do it. So I'm on this adventure.
I can't wait to read it.
So it's going to be visual as well as text. It's not going to be a heavy tome. It's going to be, interesting to read. And there's going to be personal elements to it. So if you had to pick up the book off the desk in front of you and flip through it, you had time, you're waiting for your Uber, what have you, and then you got to the end and you said, well, hang on, Graham, my favorite top 100 moment is not here. What would that moment be?
Well, I'd probably be wonky about it. Don't be shocked. And focus on the economic side. So what about watershed moments, like when the largely, in relative terms, unsubsidized renewable energies became more cheaper or more economically competitive than heavily subsidized fossil fuels in many use cases, right? Thus proving that fewer emissions and economic growth can coexist. Not only can they coexist, but they constitute a flywheel,
right?
Helping economic growth on a no carbon. Or what about when Tesla proved that the old narrative that EVs suck and they're just vaporware, proved that wrong, and basically single-handedly dragged the world into the EV era and out of the ICE era. These are transformative for impact investing because they proved our thesis was right.
Right. And so in that first example, would that been one of those contracts that were published in the Gulf? Or I'm trying to remember. Was it Bloomberg New Energy Finance who put something out? There's been several, but which one stuck out for you? Can you remember? No.
I will look back and remember exactly, but I think it was one of the ones in the Gulf. I want to say it was Emirates or Qatar signed the first solar power purchase agreement that was under 3 pennies a kilowatt hour.
Yeah.
This is when the global average for coal was a nickel.
Right.
And that was it. That was okay. For a long time, there was this conversation of, well, renewables are never going to hit grid parity. And now that just sounds quaint. Renewables have hit grid parity and blown its doors off.
Yeah. And
they're going to continue to. Let's be very clear about the distinction. Renewables are technology-based energy, not commodity-based energy. Yeah. So therefore, the more demand there is for them, the cheaper they get, as opposed to commodities where more demand equals more expensive.
Right.
It's transformative. It's a big deal.
Yeah, so much fun. We could do a deep dive just on that alone.
That'd be fun.
Excellent. So
you're listening to the ESG and Coffee Podcast, hosted by Graham Sinclair. Вы слушаете ESG and Coffee Podcast. С вами Graham Sinclair.
Excellent. So here we come. So that's end of deep dive 3. We're coming into land fast now. So this is our last squad of fast espresso shot questions. Are you ready, sir?
Ready.
All right. What is your favorite word?
I guess epistemology.
Nice.
The science of how we know things. Science is how we know things.
Very good. Yeah, you had that whole PhD adventure we don't have time to go into.
That was.
What is your least favorite word?
I thought about this one for a minute. I think it's externalities, because external to what? You know, except for the occasional meteor or whatever, the Earth is a closed system. It's all here. We don't have externalities. You think of it all in an integrated way.
Nice. What profession other than your own would you like to attempt?
Not really sure. Maybe we should open that coffee shop.
Done. With the gravel bike racks at the front, right?
Yeah, that'd be great.
No. What profession other than your own would you not like to attempt?
You know, it's related to in finance. I don't think I could ever do tax accounting.
Yeah, I agree.
Straight headache.
Yeah, agree.
Those people are overcompensated for a good reason.
Like first grade teachers.
Yeah.
Not overcompensated, but compensated for a good reason. What attribute does an excellent investor have?
Well, I think a great investor understands that they're buying something today that represents a fantastic value in the future. That looking at it that way frees them up to look everywhere, to go anywhere, to forget about banal stuff like tracking error and focus exclusively on what's coming next.
Okay. Which talent would you most like to have?
I'd like to be, you know, I speak English and I can sort of speak French and I can speak a little bit of Spanish. I'd like to be a big polyglot. That would be awesome.
Nice. 5 languages. Yeah.
Yeah.
Which living person do you most admire?
You know, I already cited one of his books. I really admire E.O. Wilson.
Okay.
He's, you talk about epistemology. He insists on having this very tight focus on seeing the world as it is in an evidence-based way and thinking through how to solve our problems on the basis of what we really are, not on what we imagine or, you know, some Bronze Age fairy tale that we still cling to. He's tough that way, but I think that's how we need to be.
Yeah, I was paging through the library. I saw something he did just on ants. I just couldn't bring myself to read it, but yeah.
Yeah, me neither.
Respect. What do you consider your greatest achievement?
You know, I hope I'm a good friend and a good uncle and brother and son. I want to be there for people. I hope that's true. That's aspirational. But that would be that would be more important than whatever I could pull off at Green Alpha.
Fair enough. And finally, what is your idea of perfect happiness?
Being content as one can be in this world, that you've done what you can to make a real contribution, to help us all, to preserve what we love.
And
that would make me happy.
Let me ask you to build on that. Picture yourself, where are you sitting or standing in that when you feel that?
Probably at the end of the day, maybe even at the end of the career. Sitting somewhere nice with a pint of something good in my hand and reflecting about it. And in a Wilson-like way, being able to objectively quantify that I pulled that off and not just imagine that I did.
Okay, good. Right, so to your action question, this is your opportunity. What action do you want our audience to take tomorrow, wherever they are along the investment value chain, whether they're professional investors or not, big or small, in your backyard or anywhere? What action call do you have?
Well, you know, from my point of view, it's all about looking at what you own, knowing what you own. You know, this is time of crazy high risks, but also accelerating solution sets. So have a proactive plan. Get your assets in front of the best solutions. If a company's net activities don't create a better world on an ongoing basis, we shouldn't own it. So I guess I would say, look closely at everything you own and make sure you're actually in alignment with what you own and haven't just assumed that you are.
Got it. Thank you. So to the Goldilocks question, we come into land here. My final question.
All right.
One share of Tesla, TSLA, trading today on NASDAQ at around $678 minus 560 at the time, right? Again, it's never boring with Tesla. It's either up or down, never flat.
That's for sure.
All right. Is that price too high, too low, or just right?
Well, this 100% comes down to time horizon. If you're holding for 6 months, you just better not. So I guess that's my way of saying it might be a little high on the short term. If you're looking at 2030, you should hold it. It's too low.
All right. Thank you very much for your answer. You've been a fine guest, Garvin Jabusch, co-founder and chief investment officer at Green Alpha Advisors. You're one of the originals. Hear this from me. Thank you for your hard work over many years, making new paths in the practice of investment and finance. I like to say the investments you make become the world that we all live in. So thank you for trying to make it better. And thank you so much for coming on the ESG and Coffee podcast.
Thank you, Graham, the ESG architect. It's been a real pleasure.
Thank you.
And now we keep the tape rolling to hear from Graham and his guest as they reflect on their discussion and anything they wanted to add.
And now time for our bonus tape. Please grab another sip of coffee. In the bonus tape, I like to keep the Zoom rolling and check with you. Is there something we missed? Is there something you'd like to expand on or anything you'd like to clarify?
Geez, I don't know. You were so thorough. I don't feel like there's too much. If we don't solve our investment flow issues at scale, away from problems and into solutions, we're not going to solve the climate crisis or grow the economy, and it'll be game over. Like that's a little sharper than I put it earlier, I think.
Yeah, fair enough. So if I may, there's two pieces I didn't get to that I thought about during, but we had to keep moving. One was your team, the people around you. You've got your colleague, co-CEO, and then I wondered about how else are you building your pipeline of talent? Do you need to? Do you want to? Or you think of that? So can you talk a bit about the people around you?
Yeah. So Jeremy and I are the portfolio managers. The investment committee additionally includes Betsy Mosetter.
Yes.
And she has a long background in asset management. She worked at a firm in DC called Tamro, which was a mid-cap growth manager. That makes her skill set very applicable to what we do here.
Right.
And that's been very helpful. So she serves on the investment committee, although is not listed as a PM. And I think this is important, right? Because, cognitive science shows that the more diverse viewpoints you have, the better long-term decisions you make.
Right.
Here again, that's something Annie Duke would agree with. And so I think it's important for us to have those diverse viewpoints. And as we grow assets under management, and as we see the interesting securities we look at begin to proliferate, I do, to directly answer your question, think we need to grow the team. And so we are going to, over the next quarter-ish, depending on who we can find during the tail end of the pandemic here, we are going to add an equity research analyst to the team. And additionally, we have already hired and will very soon be having an operations and finance manager start to take some of the other responsibilities away from both Betsy and Jeremy. So they therefore have more bandwidth to work with me on the portfolio management side.
Okay.
So that is a big deal. We do need to expand our capacity there because I am pretty sure we're leaving some stones unturned.
Yeah, possible. It's possible. And then the second piece is, so you've got a very clear thesis and view of how you'll figure the investment returns. So, but a lot of these technologies or these companies are younger, right? So that means, so could you translate what you do into private equity or venture capital or infrastructure in some kind of hybrid way? So have you looked at playing in those sandboxes at all?
I think that our approach is very applicable to private equity. I didn't, pardon me, I didn't go as far into it as I could have when you asked about the genesis of our investment thesis. But part of it was that while we were, Forward Funds was the financial services arm of the Getty family office. And Jeremy and I worked directly for Gordon Getty. And so him being a polymath in his own right, and not just saying something nice about the rich guy, he really is. And he wasn't content just to have us sitting back managing the Sierra Club stock fund. So he was sending us down from San Francisco to Sand Hill Road quite often to vet clean tech opportunities that the family office had on the private equity side. And one of the reasons we developed our our approach to portfolio construction is we thought, wow, there are some really great ideas out here, and having to really interrogate every company from the floor up, as opposed to trying to hammer away at an index to try to make it more green, really would be interesting. And so our whole thesis is about evaluating every individual holding on its merits, and that's exactly the private equity approach. So yes, is the boil down to that? Yes, we could be doing private equity, and more than that, I think we would like to. We don't have the wherewithal today, because our bandwidth is all taken up managing our current strategies. But in the fullness of time, if I got to the point where I could feel comfortable taking a higher level, as opposed to every moment hands-on, higher level oversight role on the public equity side, I would like to start that. I think it'd be very interesting.
And flowing on then, a National Renewable Energy Laboratory, NREL, is somewhere in Colorado, if I'm not mistaken. Yeah,
it is just a few miles up the road.
Yeah, and so I've sat on their their vetting committee for several years, and where they just want some investor perspective on, and they run some competitions and so on. And so I was wondering if that might be a rich source of ideas and or a community of interest.
Absolutely. I do have a couple of contacts there that I chat with from time to time. Before there was a pandemic, I used to like to go to their open houses and see their student competitions, and there's all kinds of interesting stuff to do there. Hey, Graham, that's not the only thing here in Boulder County. So many of the national labs and enterprises are here. Snow and Ice Data Center is here. National Center for Atmospheric Research is here. For some reason, when they were handing those out during the New Deal, the senators from Colorado had a lot of influence, and so they got a lot of them put here. In fact, Jeremy's brother, Dr. Jeff Deems, is a scientist at NASA here and at the National Snow and Ice Data Center. His doctorate is in snow and ice and fluid dynamics associated with that. He's helped us understand a lot of very interesting stuff around water and around the climate crisis. So this is very fertile ground for that. It's one of the reasons we moved Green Alpha here from its founding in San Francisco.
Got it.
Well, I hope you enjoyed that conversation with Garvin Jabusch, Chief Investment Officer at Green Alpha Advisors, as much as I did. We covered a lot of ground. I really appreciated how we got into some of the detail on his investment philosophy and the process, how he takes his investment thesis and puts it into action, looking at listed companies mainly. And some of the nuances of what that takes, how he was thinking about, what do you do about energy companies and how to track the amount of revenue they're making from non-polluting activities. And that worked example we had of the offshore wind contract that was won by Equinor, BP, and Ørsted in New York State, and how to decide when he would go into a BP or an Equinor, for example. I think that those are the edges, those are the gray areas where applying the skill and looking towards where a company has gone and is going in future helps differentiate the active manager and the specialist boutique. I did not expect to hear Garvin talking about how he would love to step into the private company space, running a private equity version of a strategy. But as we were talking, and you heard me posing that question to him in the bonus tape, as we were talking, it kept coming to mind is, this strategy it's fairly concentrated, it's unique, and it would almost fit the longer cycles, particularly type 2 private equity, the growth capital model, where you've got maybe 10, maybe 12 years, and a board seat, a minority investor, but an influential investor in a portfolio company. You have the position in which you can look to influence the strategy and the execution of that strategy by the portfolio company. Important, of course, to flag for you that Green Alpha Advisors is hiring, which I think is really, really exciting. We have got the link to that in the show notes, something that Garvin was looking towards when we did that interview in late spring, Northern Hemisphere spring of 2021. I did ask Garvin, was there any update or anything we kind of talked about? First of all, the EV supplier that he was going to be exiting on account of the all-terrain vehicle that was a bigger portion of their revenue. He said it was Kandi Technologies, Kandi, ticker KNDI. And he said they've reported once since then the share of revenue from their internal combustion engines has decreased, but not enough for his liking. So it's likely that he'll probably look to go ahead and exit that. He says they have issued new ADVs to the SEC, and I'll include that as well as the original ones we used for our conversation. And he also, the most interesting update was in the biotech space. We had that great conversation about Moderna and other biotech therapeutics. And he said the most compelling information is there's been a release of results from a firm that after a trial on human patients where targeted gene editing based treatment did produce the desired outcome in terms of disease mitigation and did so safely. And that was the first time a published result showed that CRISPR and Cas9 gene editing therapy did indeed work in human patients in vivo and seemed to be a proof of concept. So we'll still see how that plays out. Obviously, he was well positioned. I appreciate his personal reflection, his disappointment that he had looked, for example, at BioNTech and just chosen not at the last step to go ahead and buy into them. Even though he'd formed a good view of the space that we're in. I'd also include in the show note and give a shout out to the Walter Isaacson book on the scientists behind the gene editing therapies, the two women who won the Nobel Prize in December of 2020. And so let me end here and again say thank you so much for listening to the ESG and Coffee podcast. I hope soon we might have another triple-digit fund manager on our interview. It was remarkable to hear from Garvin how much there's an upside and a downside to being the popular manager, the flavor of the year, if you will. And again, the disappointment of seeing money flows chasing past performance, which is exactly what one shouldn't be doing as an investor. A reminder, ESG and Coffee podcast is not investment marketing or selling. Do your own research. ESG and Coffee podcast is about investing and the business of investment through the eyes of an ESG architect. If you have an idea of a great guest you'd like us to interview in season 1, the originals, those who've been doing it for longer than the last bonus cycle, please do hit us up on Twitter at ESG and Coffee. On Twitter. You can find me at ESG Architect. And thank you so much for listening. I look forward to sharing with you our next interview very soon.
We hope you enjoyed the interview with one of the originals in investing, strategy, and sustainability. Please subscribe on your favorite podcasting platform or on YouTube and leave a 5-star review. Bad reviews you can send to Graham Sinclair at ESG Architect. All the details are in the show notes. And for news of our next guests, follow us on Twitter or Instagram at ESG and Coffee. Do you know an impressive human we should absolutely interview on investment, strategy, and sustainability? Please let us know on Twitter at ESG and Coffee. Our producer is Kat Farquharson on Twitter at Kat Farquharson, and original music by Aaron Bonney on Twitter at Aaron Bonney Music. And of course, this podcast is for your enlightenment, not investment advice. Do your own research.
You have been listening to the ESG and Coffee podcast on investing, strategy, and sustainability, hosted by Graham Sinclair.